Hello, everybody. Welcome back to Every Day is Saturday. I'm Matt Stahl here with my partner, Brad Gatto, and we have an exciting topic today.
Oh, yeah. Just one that we're super jazzed to talk about.
We're going to talk about inflation.
Are we the worst financial advisors ever? We don't get super excited about talking about this kind of stuff.
We're going to make it exciting.
Okay.
There's going to be a little history lesson.
Well, you did do a special voice for it, so
yeah. Well, I was waiting for some sort of sound effect.
Let me see what we got here. I forgot which one's which.
Inflation. There we go.
I don't
know. Before we get into that, what's new?
You know what? I don't know the lag time between the time that we record these podcasts and when they actually come out. So maybe this isn't, super timely, but it's getting close as of the recording of this to the time of year of March Madness.
Oh yeah.
And it's no surprise to anybody that's listened to our podcast from day one or that knows us personally, but we're both from Iowa, both Hawkeye fans. And yesterday was a big day because the Hawkeyes women won the Big Ten championship yesterday. Nice. So I
did not know that.
That was awesome.
That's exciting.
Yeah, Caitlin Clark on their team is the first women's D1 basketball player ever to lead the country in both points per game and assists per game.
Huh. Wow.
First ever. So that's pretty awesome.
That's cool.
And then the Iowa Hawkeyes men's basketball team yesterday played their final regular season game and unfortunately lost at the end to Illinois. But the Big Ten tournament's coming up starting on Wednesday and then this Sunday, Selection Sunday. And I think that's the best sports out there, man. The first weekend of March Madness, I can't remember the numbers, but corporate America loses like billions of dollars in production from inefficiencies of people at work because they're watching 3 screens because there's multiple basketball games going on at one time.
So I grew up a massive sports fan, and my basketball participation has kind of evolved into this is about the time of the year when I start
You
paying
kick
attention.
You kick in.
It is exciting. No, and I don't care who you are. It's fun. It's fun to watch, and it's exciting. So
how about you? Other than March Madness,
we're ready for spring. I mean, we're winter enthusiasts. We get outside a lot. We like to snowboard. We like to be out and about. But man, it's been an interesting winter, and we're just ready for some sunshine.
I resonate with none of that. I am not a winter enthusiast.
So you're just ready all around.
I'm ready for spring at about January 3rd.
Yeah.
I like having a white Christmas, but past that, I'm done.
Yeah,
I don't go outside.
Oh, we're on the same page.
Yeah,
ready to move on.
So, Matt, here we are. We're having this conversation because it's a timely conversation. Inflation over the last 12 plus months has, in recent memory, gotten more out of hand than it has been in, the last decade or two.
Yeah.
And so it's on people's minds, and because it's on people's minds and it has the possibility of affecting their financial plan, we wanted to kind of talk about it a little bit today. And so we're going to talk a little bit about the history of inflation and kind of, because history, as Mark Twain says, is we had an episode with Ed Slott a little while back, and he kept pulling out quotes from the Farmer's Almanac. What's it called?
Poor Richard's Almanac.
Poor Richard's Almanac, not the Farmer's Almanac. I again grew up in Iowa there. Used the Farmer's Almanac, not Poor Richard's. But the Mark Twain quote that history doesn't repeat itself, but it definitely rhymes.
Yes. Yep.
So we'll talk a little bit about the history and then just talk about what it means for people today and kind of what's driving inflation and what that looks like.
Yeah. And I just want to put a pin in right here. If you're tuning in to get some investment advice, it's not going to happen. We're not going to predict what's going to happen. This is more understanding inflation as a concept, what we're experiencing, and give us some perspective on it. So
yeah, I do think we can, at least for a minute, just discuss from an investing perspective how to be cognizant of it, because we are right. And the way that we've positioned our clients' overall financial plans aren't blind to it. We're not sticking our head in the sand. We're not doing nothing.
Right.
But the things that we are doing are very fundamental, not emotion-based, and we're not trying to predict where inflation's going. So we can talk a little bit about that too. But let's talk a little bit about history, because inflation's been around since currency has been around.
Yeah.
right? The second people stopped trading goats directly for beans, and then they put any sort of currency or means of exchange in there, the value of that means of exchange or currency has fluctuated. And there's been points in history where, like, dramatically, as we were preparing for this podcast, you and I were having kind of a, calling it a fun conversation almost seems mean, but the Treaty of Versailles after World War I that Germany got put under, and the type of inflation that caused for that country at that time was crazy. I mean, at the beginning of that treaty, 1917, 1918, stressing my knowledge here a little bit, around that time, their paper money to kind of the gold mark standard was close to 1-to-1. And 5-6 years later, it was $1 trillion with a T,
crazy
to 1. So inflation is definitely real, and it's been crazy at times. But here in the United States, if you go back to kind of the turn of the century and what we've gone through from an inflationary perspective, most periods have been inflationary. We have hit a couple deflationary periods where it's the opposite, cost of goods actually go down. But for the most part, and the big one, of course, being the Great Depression and deflation, by the way, it sounds really good in theory. Like, oh, I would really love it. Everything just kind of, all the prices kind of collapsed, but there's a whole separate set of problems that can come with that.
Yep.
For the most part, we've had inflation. The cost of goods just kind of goes up over time. And so, fun fact for you, back over 100 years ago, back in 1913, a little bit of fun math for you here, Matt. The American dollar in 1913 would have bought you 30 Hershey's bars.
Huh.
That means 3 cents
for
a Hershey's bar. You could have gotten 30 Hershey's bars back in 1913. Fun fact about that. Yesterday, I was on my way to baseball with my son Hudson, and I was pumping gas. He's 8 years old. And so I was getting, I was spending a lot of money. Spending a lot of money at that gas pump, as we all know right now. And I sent him into the gas station with a $20 bill. And because we were on our way to baseball, and I was like, look, you can get yourself a Powerade, get one treat. You can have it till after baseball, and then get me a Diet Coke and a protein bar. And that's what I asked him to get. He comes back out. I had about $10 and change. And I was like, what'd you get for a treat, buddy? And he said a Kit Kat bar, which I thought was interesting anyway. I didn't know my son really like when you send a kid into a convenience store and you give him free reign of the convenience store, that's what he came back with. I thought that was interesting. But it was a king size Kit Kat.
Ah, there you go.
It wasn't just a normal Kit Kat. But then he immediately explained it away to me. He's like, well, Dad, I was going to get the normal Kit Kat, but then I got to the counter and the king size ones were sitting there and they were on sale for 99 cents. And it was cheaper than the regular size Kit Kat. So the sale price of a Kit Kat was $1, but back in 1913, you get 30 Hershey's bars. Oh, by the way, the Diet Coke he got me was a fountain Diet Coke. I didn't ask for that. I thought that was interesting too. I got a fountain Diet Coke. So
I would love to watch it.
Yeah. He came out and he had like this big, huge fountain, like big gulps, huh? So then fast forward a little bit, go to kind of World War II time, 1944, that same dollar wouldn't have bought you 30 Hershey's bars, but would have still bought you 20 bottles. Bottles is a key word there because they were glass bottles back then. 20 bottles of Coke. You'd have gotten in 1944 for that dollar. Fast forward a little bit further. In 1964, you could have still gotten into a drive-in movie for $1. Go a little bit further, 2008, you still could have gotten 2 lemons for $1. And then today, because McDonald's is so kind to us, you can still get a cup of coffee at McDonald's for $1.
That.
Or a king size Kit Kat when they're on sale at Quick Trip. So, and a couple of things to note in there, our dollar has had less inflationary pressure and movement, volatility in price because we're the reserve currency. That happened back after the war. Around 1944, we became the reserve currency of the world. But then in 1971, we went off the gold standard, which is just a really fancy way to say we used to have gold that backed every dollar that we printed.
Yep.
And we had to have that gold. Otherwise, we couldn't print more money. And in the 60s, they started feeling pressure because we needed, or they thought we needed more paper money in the system to kind of run our economy, but we didn't have enough gold. And so Nixon did away with the gold standard in 1971, which of course added a little bit more volatility to the price of our currency. And I know you're going to talk a little bit more about kind of where we're at today, but I don't want to steal your thunder. Fun fact now into the 2020, we printed 3.8 trillion with a T dollars. Wow. $3.8 trillion we printed in 2020. That is equal, Matt, to 20% of all dollars ever printed.
My goodness.
In 2020.
That's crazy.
So there's that.
Yeah.
Now we couldn't have done that if we were on the gold standard.
There is that.
So there's your history lesson on inflation in the United States. There you go.
Great. I feel great.
That's it. That's the end.
That's the
no practical application. Welcome to hardcore history.
Welcome to well, I thought it'd be helpful to sharing kind of the conversations I've been having with clients lately, because inflation is something you're hearing about everywhere you go, and it has been for some time here. So we have many clients that are currently collecting Social Security. And because a lot of the families that we do serve are retired, and so Social Security makes up a part of their paycheck. And I just kind of played a fun game and asked everybody if they knew what they're going to get for a raise coming up. And most people weren't aware, but the cost of living increase for Social Security for this year, which is based on numbers from last year. Do you know what it was?
Well, I do, but
so 5.9%. And just to put that in perspective, if we look back over the past, going back to really 2008, 2009, we haven't even come close to that. The closest we came to that was 3.6%. And that was back in 2012. We had a couple zeros in there, some 1%. And I'm not saying this to sound ominous or scary or anything, but the last time we saw anything even near 5.9% was back in 2008. And at that point, we were at 5.8%. And if you look back and you sift even further back, it's back into the 80s until you see something even close to those numbers.
Now I'm dating myself here, but what's interesting is the 5.9% pay raise that people collecting Social Security got this year, which, by the way, another fun fact for you, the pay raises are based on the CPI, a subset of the CPI called the CPI-W, which there's multiple CPIs that are measured, and the subsets, like the W, just tells you what the basket of goods is that they're measuring inflation off of. The W is the workers' CPI. So it's what the average worker is spending their money on, even though Social Security is for retirees. But
makes complete sense.
I digress. But in the 5.9 was the largest, you mentioned it, since the early 80s, 1982. Also happens to be the year I was born.
Oh, there you go. I'm dating myself. Might be doing the opposite.
I turned 40 this year. It's a big year.
Also, just as a little context, I was born in 81. The cost of living was 11.2%. It was only 7.4% in 82. So,
see, inflation was better in my year.
The year before that in 80 was 14.3%.
Oh my gosh.
So the history part of this, I always think it's interesting to ask people. We talk a lot about biases as human beings, right? And we're all big fans of paying attention to behavioral finance. Why do we do the things that we do? And one of those biases is the recency bias. And as humans, we have a tendency to think whatever has happened most recently is just normal. And think about this. I often talk to people, and they're really bummed out if they didn't get 2.8% on their mortgage instead of 2.9. And just to have some perspective, it's you ask somebody that was at a point where they're buying a home back in the early 80s, it was completely normal to go pay 16-17% for a mortgage. So it's all somewhat relative. You're
getting good pay raises in your Social Security, to your point of 11, 14, 7.
Right.
But when you're paying 16, 17, 18% for your mortgage payment, from an interest perspective, it's all relative.
Right. So this interesting thing when we look at this, the inflation that we're currently experiencing is really the good kind of inflation, if you want to call it that. Now,
come on, it sounds like you're putting
trying to sell. Yeah. So bear with me here. So if we go back to the early,
do you work for Congress?
No, in fact, write this down. That never going to happen.
Okay.
Noted here. But if we go back to the early 80s, we were experiencing stagflation, which is the price of goods around us. Everything is going up. So the cost of everything around us is going up. However, in general, we saw wages coming down. So people were making less money. Meanwhile, the cost of goods around us is going up. This time around, we're actually experiencing the opposite. So we're in general making more money than we've ever made. We've all been sitting around in our underwear for the past 2 years, and we want to buy everything off Amazon, right? So
Little do the listeners know, we could be doing that right now. The camera is waist up.
But the demand is there, right?
Yeah.
So the cost of things are going up because they're not as readily available, and we, in general, and not discounting, that's not the case for everybody, but in general, we're all making more money and we want to buy more stuff.
Yep.
So if there's a good kind of inflation, I would say this is the good kind of inflation. And to throw in some more history, a lot of the conversations I've been having with people, taking us back to 2008 and 9, as part of the financial crisis, when we look back then, the federal government and Federal Reserve really have these two levers that we can use to have some effect on the economy as a whole.
Mm-hmm.
And those two levers are how much money is out there and how expensive is that money. And go back to 2008 and 9, we talked a lot about this post 2020.
Yep.
Where at that point both levers were pushed all the way full steam.
Yep.
In 2008 and 9 to get us out of that, and the response took a handful of months for that to go into place. This time around, one of those levers has basically been pushed and left there this entire time. So, and that's the cost of money. Money has been essentially free.
Yep.
So that's called the Fed funds rate. And that's been at zero or close to that for a long time.
Yeah.
And that other one is how much money is actually floating out there and is exchanging hands. And so the pace at which we saw that response this time was a fraction of the last time around. And so we look at that, and those two levers, one of them has been pushed all the way.
Yep.
Where there's not really much to fall back on. And so in looking at that big picture.
Well, what you mean by that, just to clarify, what not much to fall back on, is both levers are full steam ahead. You have you've exhausted whatever options you have to maintain economic growth and expansion.
Right. So Federal Reserve has been in this position where basically the rhetoric has been, hey, it will raise interest rates as soon as we see inflation come. And if you follow, any of the communication there, it has been communicated that we'll see 2 to 7 rate hikes throughout this year. So this is really what they've been
2 to 7.
2 to 7. Yes. Very exact. 2 to 14.
It's an exact science.
So if anything, I know it's not fun to pay more for goods, but we're actually seeing stuff, go back to more normalization as far as when you look at it from a historical perspective. So.
Yeah. Anything else you want to add to that before we?
No, I think that's it. Just from big picture standpoint, it actually seems like things are going back more to normal from that perspective.
Yeah, I think another couple of things to add to that are worth noting is you already kind of mentioned how inflation can be good for the economy. It's not necessarily a bad thing. It kind of can be a sign of a healthy, growing economy. Obviously, too much inflation can be a terrible thing.
Mm-hmm.
And I think you talked about recency bias, but it also really hits home when the things that are, having the highest inflationary rates are the things that you and I use or buy every day.
Right.
Things like gasoline. Now, I looked up some of these numbers, and this data is a couple of months old now because it's hard to find stuff that's like up to date today. But at that point, a couple of months ago, gasoline was up 51%.
Oh my goodness.
The cost of beef, which I'm a big fan of, that's 24%. That's up. Vehicle rentals, almost 40%. Just used cars. I mean, we've all seen that. Like most of these car lots you drive by these days are almost empty because they're just hard to come by. So that's caused inflation, 26%. And so there's just a lot of things around us. Even natural gas, if you're using that in your home, 28%. Eggs are up over 10%. There's just a lot of things that we've experienced, a lot of inflation around the things that we deal with every single day. So it's been felt. And so super high inflation is not good, but some inflation signals that we're in a good growing expansionary type economy.
Right.
It can also be good for borrowers because when you think about it, if the Fed has rates held artificially low, which they do, it's not, maybe you can't find that 2.85% mortgage anymore and it's more like 4. But if inflation's running at 6 or 7%, you get to borrow somebody else's money to pay for your house at 4% when the value of your dollar is declining by 7%, but you didn't use your dollars to buy the house. You used somebody else's dollars. So the somebody else or the bank in this situation are the ones losing out to inflation, not you. You get to pay them back over time with future money. And that money is being devalued at a faster rate than the rate that you're paying. And so there's kind of some arbitrage there in times like this. So it can be good for borrowers. It can be good for homeowners. I mean, if you're looking to sell your home, we've all seen what's happened to the price of a home here recently. Obviously, if you got to go buy a new home, you're going to end up paying again on the back end. But, if you're one of those lucky people that's selling a home and not looking to buy a new home, or maybe moving to a different market where the inflation isn't quite as hot, there can be some opportunities there. Higher wages, you already mentioned that. It's led to higher wages for us. And at the end of the day, when it comes to what you and I do every day for the families that we serve and the planning that we do, this is part of the plan. Inflation's not new. It's not a surprise, right? We don't know what the number's going to be, but we expect it, right? Every plan that we build has inflation built into it, every one of them. And when you look at overall asset allocation and all that, people are always like, well, what should I be doing? At the end of the day, certain asset classes just do really well. And I think the one that's at least worth noting today that I think is, once you hear it once, you're like, oh yeah, it makes perfect sense. But unless you've never really thought through it, is commodities. So oil and gas, beef, beans, all the things that we either make or supply, a commodity, they're kind of the leading indicator of inflation, right? And so if some of your portfolio is in commodities, you're going to be in the exact thing that's driving the inflation, which means should be getting commensurate returns to be able to try to offset some of that stuff.
So you're on the buy side and the sell side.
Yeah, exactly. Right. Yep, exactly.
Yeah.
So practical question, Matt, if you're out there listening to this podcast and you're not a family that currently works with fiat, what, if anything, should you be doing differently right now?
Yeah. I think just as part of the investment strategy is reviewing their asset allocation. Where are we right now and what do we see for the future, and ensuring that falls in line with, if the plan isn't there, if the financial plan is not in place, and this is just an investment strategy, then I think it's all pointless. So first and foremost, ensure you have a financial plan. If you're retired, you know where your income strategy is, and then the investments will overlay on top of that. And so it is a great time to just review that asset allocation. And if your approach does not take that into consideration, it might make sense to evaluate that in the future. Just updating the asset allocation according to what we're seeing everywhere.
Yeah. So. To drill down even one step further, and we don't normally get into a lot of, nitty gritty detail in this podcast because neither you or I get super excited about this kind of stuff. But to add on to what you said, when you think about asset allocation, overall financial plan, and inflation being a part of that, one of the biggest mistakes I see people make, Matt, is that you get to retirement and it stands to reason and it seems logical that you need to back off the risk in your global portfolio, right? And so maybe I'll just give an example. Let's just say you were 80% stocks and 20% bonds leading into your retirement, and then you get to retirement and you kind of read some stuff online. You're like, oh, I should be backing off my risk. And standard retirees in 60-40 blend, 60 stock, 40 bond. Well, how well do bonds do in high inflationary environments? Well, they're terrible. It's one of the worst asset classes you could possibly be in.
Right.
But then the natural question is, well, what do I do? Because if I get out of bonds, I'm adding more risk to my portfolio. And because I'm spending my money and I got sequence returns risk and all these things, that doesn't seem to jive either. And so as a practical matter, part of that financial plan is looking at creating, we call them, time buckets or now, soon, later monies, and segmenting your money or siloing your money in a way that you've got money that's set up to be spent in the short term. You've got money that's in kind of a quasi growth mode, but a kind of a protective mode that you need to use in these kind of midterm years, not immediately, but money we know we need kind of soon. But then there's a bunch of money that you have that is later money,
right?
Because we don't spend the whole pile in one day. It's going to be spent over time. And so the majority of the money is usually a 10-year plus bucket. And at the end of the day, if you've got 10 years, there's not a lot to be fearful of as long as you've got good allocation and you're sticking into a stock heavy portfolio. But the only way you have the autonomy to do that is if you've taken care of the short term. Right. And so making sure you have enough stocks because stocks are another wonderful asset class during an inflationary environment, because we need those high growth rates to overcome inflation. But how do you do that while you're in distribution when you start to silo your money?
Right.
Another practical example.
Yeah. Well said.
We got through an entire podcast about inflation.
Yes. You need to do a sound effect.
I don't know if, There we go.
Yes.
We did it. Having the everyday is Saturday lifestyle while talking about inflation.
Did it.
Guys and gals and everybody else that's listening to this podcast today, I hope you learned something. And at the end of the day, the message that we really want to send is in order to live an everyday, a Saturday type lifestyle in the face of things like inflation, because it doesn't have to be scary and it shouldn't be scary. Should be expected, and you should have a plan centered around it so that when it does happen, you can put the newspaper down, stop paying attention to it, and just go on with the plan that you've set in place. And that's kind of what Matt was alluding to earlier. And so hopefully that is the case. If it's not, give us a shout, because this is not something that should be a concern to you when it comes up. As always, thanks so much for listening to Every Day is Saturday. If you want to reach out to us here at Fiat, our website is going to give you basically everything that you need. So you can find us at www.fiatwm.com, fiatwm.com. I'm not going to say the W's again. That's hard. So we all know that part by now, don't we? The internet's been around long enough that I can just get rid of that part.
I think we're good.
fiatwm.com. If you want to subscribe to the podcast, we'd love it if you would do so. Even if you don't want to, we'd still love it if you would subscribe to the podcast. Go ahead and share it with your friends and your loved ones, and maybe even a random stranger on the street. Just let them know that they can live an everyday Saturday lifestyle. Show them the podcast. We'd love that too. I'm Brad Gatto here with my partner, Matt Stahl, and we'll see all of you guys and gals next Saturday.